Before we talk about exchanges or assets, we need to understand intellectual property. Intellectual property, or IP, refers to creations of the mind. That includes music, films, books, designs, inventions, brand names, logos. IP is protected by law through mechanisms like copyright, trademarks, patents, and trade secrets. Unlike physical property, IP is intangible. You cannot touch it, but it can generate income. For example, a song generates royalties, a patent can be licensed, a trademark protects brand identity, a film can be distributed globally. IP becomes economically powerful when it's protected, documented, licensed, commercialized. It is not automatically valuable. Its value depends on market demand, enforceability, and monetization strategy. At its core, IP is ownership of creative output and the right to control how it's used. A stock exchange is a regulated marketplace where ownership shares of companies are bought and sold. When a company goes public, it issues shares to investors. Those shares represent partial ownership. The price of a share was based on supply and demand, company performance, investor sentiment, economic conditions. Public companies trade on exchanges like the Toronto Stock Exchange, the New York Stock Exchange, and NASDAQ. Investors can buy and sell shares at fluctuating prices. The company receives capital when shares are first issued. After that, most trading happens between investors, not the company itself. Stock exchanges are regulated environments designed to provide liquidity, price discovery, transparency, investor protections. They are built around equity dilution, meaning ownership is divided among shareholders. Intellectual property and stock exchange equity operate differently. IP ownership is typically retained by the creator or assigned to a company. It can generate income through licensing, royalties, distribution agreements, and sublicensing. Public equity, on the other hand, divides ownership among shareholders. IP can exist inside a public company, but it can also exist privately. A musician can own 100% of their catalog. A public tech company might own patents that support its valuation. In stock markets, value is influenced by speculation and investors' perception. With IP, value is tied to enforceability, licensing, strategy, and demand. One is a marketplace for ownership shares, the other is ownership of creative or innovative output itself. IP becomes powerful when it's structured. A single song is creative output. A catalog of songs becomes a royalty-generating portfolio. A patent portfolio can secure licensing revenue across industries. A brand trademark can anchor global franchising. In financial markets, IP is often treated as an asset on a balance sheet. It can be valued, sold, collateralized, licensed, but unlike stocks, IP doesn't trade on an exchange in real-time markets. It's typically transacted through private agreements. That distinction matters. IP is not automatically liquid. It requires contracts and enforcement. Both systems create capital. They just operate through different mechanisms. If you're building creative infrastructure, you need to understand, are you selling ownership or are you licensing output? Public equity spreads ownership. IP allows control to remain centralized while monetizing use. Stock exchanges are optimized for capital raising and liquidity. IP systems are optimized for authorship and licensing control. They intersect, but they are not the same. Understanding that difference prevents confusion between ownership dilution versus usage licensing. One sells pieces of the company, the other licensed creative output. Two different economic architectures.